In this video, we'll use an analogy to simplify the concepts of strike price and option multiplier for you. By comparing options to buying concert tickets, we'll dive into how these factors work in context of Apple options. So get ready to grasp the fundamentals and gain a better understanding of trading options in a real way. And be sure to subscribe and like our video. Let's look at the details of buying an Apple call option using the concert ticket analogy. Imagine you really want to go to a concert, but you're worried that the tickets will sell out and the price will go up. You could buy a call option which would give you the right to purchase a ticket at a certain price, just like a call option for an Apple stock gives you the right to buy the stock at a certain price. The strike price for the call option is like the price of the concert ticket that you want to buy. For example, let's say the ticket normally costs $150 and you buy a call option with the strike price of $150. The current price of the concert ticket is like the current price of the stock. Let's say the ticket is currently selling for $139. If the price goes up to $150 or higher before the concert ticket, let's say the ticket is currently selling for $139. If the price goes up to $150 or higher before the concert, your call option becomes more valuable. The expiration date of the call option is like the date of the concert. If you don't exercise your right to buy the ticket by the date, the call option expires and you lose the money you paid for it. This is like having the right to buy one share of stock at the strike price of $150. The option contract multiplier for the call option is like the number of tickets you can buy with the option. In this case, it's 1, meaning that you can buy one ticket. But if the multiplier was 2, you could buy 2 tickets, just like the option contract multiplier for Apple stock is 100, meaning you can buy 100 shares of stock. To summarize, buying a call option for a concert ticket is similar to buying a call option for Apple stock. You have the right to buy the ticket or stock at a certain price, and if the price goes up, you can sell the option for a profit. If the price stays the same or goes down, the option may expire worthless. Based on the time of this image here, the price of one share is $138.67, but we're interested in something called a call option that has the strike price of $150. This means we want to buy the right to purchase the shares for $150 each, even if the actual price goes up. In this image, there's a number that says $2.77 in the middle bottom part. But wait, this doesn't tell us how much the option is actually worth. It's just the current price of the option. To find out how much the option is actually worth, we need to do the same math. We multiply $2.77 by 100, which is the option contract multiplier, to get the option value or option premium. In this case, the option is worth $277. Now, if we buy a call option, that means we have the right to buy 100 shares of stock at the strike price, which is $150 in this case, anytime between now and the expiration date. The expiration date for this option is in 49 days. Let's say I think that the price of Apple shares is going to be up a lot in the next 49 days. To take advantage of this, I can buy a call option with the strike price of $150 right now. I'll pay $277 for one contract of this option. In this image, you can see the stock price, and I'm using a daily chart to provide a longer-term view. The stock is clearly in a downtrend. In this image, however, it is an hourly view, and there are signs of a possible reversal. Okay, so I have a type of contract called a call option. This contract gives me the right to buy 100 shares of Apple stock at a specific price of $150. However, at the moment, Apple stock is actually selling for $172. So if I want to, I can use this call option to buy 100 shares of Apple stock for $150 each. But again, this is almost never done by traders. If I choose to exercise the option, I will have to pay $15,000 in total for 100 shares of Apple stock. That's because I'm buying 100 shares for $150 each. So here's where things get interesting. If I were to sell those 100 shares of Apple stock for $172 per share, I would actually make a profit of $22 per share or receive $17,200 for selling those shares. This is because I would be selling the shares for a higher price than what I paid for them. If you multiply that $22 per share profit by the 100 shares I bought, you'll see that I'll make a total profit of $2,200. However, it's important to remember that I paid $2.77 for the option in the first place. So to calculate my actual profit, I'll need to subtract the $2.77 from the $2,200 profit. That means that my total profit will be $1,923 if I sell those 100 shares of Apple stock for $172 each. And if I invested $276 to buy the call option in the first place, that means I'll have a 697% return on my investment. Now, Let's say I didn't buy the call option and instead just bought $277 worth of Apple stock. At the time I bought it, Apple was selling for $139 per share. If I held on to the stock and it went up to $172, I would only make a profit of $68. This is because I only bought 2 shares of Apple stock with the $277, and the profit per share is much lower than if I had bought the call option. And this is a slide that shows the option premium of $21.80. So there are 3 main points of trading options. The first one is when trading options, the goal is to profit from the option's price change and not to exercise the option to buy or sell shares. The second is you don't need to exercise the option to realize a profit. You could just close the position and take the profit. Number 3 is you don't need to hold the options to expiration. They can be closed whenever you want before expiration. Okay, so what have we learned? First, in this example, we have learned a few things about call options. First, we learned that a call option is a type of option that gives the buyer the right, but not the obligation, to buy a certain amount of stock at a specific price known as a strike price on or before the expiration date. For instance, if you have a call option with a strike price of $150 on Apple and the stock price increases to $172, you can buy 100 shares of Apple stock at $150 per share by exercising your call option. That would give you a profit of $22 per share. We also learned that the call options can be incredibly valuable if the stock price increases significantly above the strike price. For example, if the stock price ends up being $22 above the strike price, then you have a financial contract that allows you to buy 100 shares of stock $22 below the current stock price. That means you have a pretty sweet deal. We also discovered that you don't have to exercise the option to realize the profit. One of the laws in trading options is that an option must be worth the benefit or the profit that it provides the buyer should they decide to exercise it. In this case, if you decide to exercise the call option on Apple at the $150 strike price and the stock price increases to $172, then the call option must be worth $22 or more, which means that the premium has to be $2,200 or more. This is because the price of an option always includes the potential profit it could give you if you decide to buy the stock. Finally, we learned that options provide leverage return. In the example of Apple, the stock price increased by 24.7%, but the call option increased by 1,096%, meaning the return on the call option was 11 times higher than the return on the stock itself. Therefore, call options can be a powerful tool for making money in the stock market, but unlike any investment, they come with risks, so it's important to do your research and understand the potential downsides.